very strict, full of rules and calculations, black and white, right or wrong. It seems objective, like math. Accountants follow generally accepted accounting principles. These rules are meant to keep things fair. They help make financial information reliable for everyone. But here's a surprising thought. Who uses these accounting rules? People do. Accountants are people. Managers are people. Investors are people. And people are not robots. We are messy. We are emotional. We don't always think perfectly straight. We often make predictable mistakes. This is where things get interesting for accounting. So, what is behavioral accounting? It is quite simple, really. It is the study of how human behavior affects accounting. It looks at how our psychology influences financial decisions. It explores why we make certain choices with numbers, even when those choices might not be perfectly logical. Imagine a talented chef. The chef has a detailed recipe. The recipe lists all the ingredients and gives precise cooking instructions. Following the recipe should produce a perfect dish. Yet every chef might make the dish slightly differently. One might add a pinch more salt, another might cook it a minute longer. Their personal touch changes the outcome. Accountants are a bit like these chefs. They have their recipes, the accounting standards. These rules guide them. They tell them how to record transactions and how to prepare financial statements. But accountants also bring their own judgment, their experiences, their moods, their personal biases. These human elements subtly influence their work, even with clear rules. Behavioral accounting aims to understand these mental shortcuts. It wants to know how they operate. Our brains are truly wonderful machines. They can process vast amounts of information. They allow us to learn, create, and solve problems. But our brains also have a feature. They try to conserve energy. They often prefer the easy way out. They look for patterns and take shortcuts. This is usually helpful, but not always. Psychologists have studied these mental habits for years. They have identified many common thinking traps. These are often called cognitive biases. We all have them. It doesn't matter how smart or educated we are. These biases are part of our human operating system. They affect how we perceive information. They influence how we make judgments and decisions. Consider a bias called anchoring. This is when we rely too heavily on the first piece of information we get. That first number becomes an anchor. It influences all our later thinking, even if that initial number wasn't very accurate. Let's talk about something many companies do: budgeting. A budget is a financial plan. It outlines expected income and expenses. It helps guide spending for the next year. It seems like a straightforward process. Just put the numbers down, add them up. But it is rarely that simple because people are involved in creating budgets. Managers often prepare budgets for their departments. They have their own goals and pressures. Some managers might be very optimistic. They might overestimate how much revenue they can generate, or they might underestimate the costs involved. Why? Perhaps to make their department look successful, or to secure more resources for their team. This optimism can skew the numbers. Other managers might do the opposite. They might build in slack or cushions. They ask for a larger budget than they truly need. Section 5. The auditor's eye: seeing or not seeing clearly. Auditors play a crucial role in the financial world. Their job is to examine a company's financial statements. They check if the statements are fair and accurate. They look for material misstatements, errors, or even fraud. This provides trust and confidence for investors and other stakeholders. It is a job that requires independence and objectivity. But are auditors immune to human biases? Unfortunately, auditors are human too, just like the rest of us. They can be influenced by various psychological factors. For instance, they might develop a good relationship with the management of the company they audit. If they like the people, they might unconsciously trust them more. This is natural human tendency. We tend to trust people we like. This can sometimes lead to issues like overconfidence. An auditor might become too confident in the client's honesty, or in their own ability to detect problems. Section 6. Investing our money: logic or emotion. Many of us make personal financial decisions every day, whether it's budgeting, saving, or investing. One common decision is investing our savings, hoping to secure a better financial future. We want our money to grow, to see our investments flourish and bring us financial security. We look at company reports, we read financial news, we analyze market trends. We try to pick good investments, those that promise high returns with minimal risk. We often believe we are making these choices based on pure logic, carefully weighing all the options. We think we're meticulously analyzing all the data, leaving no stone unturned. But is that always true? Are our decisions purely logical? Often our emotions play a surprisingly large role in our financial decisions. Our gut feelings can strongly influence our investment choices, sometimes more than we realize. For example, we might hear a lot of buzz about a particular stock, creating a sense